Hi everyone, and thanks for joining in. We continue our dive into cash flow statement. This time we will look into financial statements preparation guide. Here is a link. We will also look into materials related to cash flow. And here is a link as well. And we will also do a bit of practice. And it's here. Okay, so let's make a step back and do an overview. We have a cash flow statement which should show us the change in our cash and cash equivalents. It should show that what were the sources of our cash in the period and what were the destinations for our cash in the period. So where did our cash go, where did it came from. And cash, as we might know, is the most important assets in our business. We can make losses but generate cash and still continue the business. We might be profitable and record the profits, good revenues, but we might not be getting cash to run the business further. And we reviewed an example of AMC, which with huge losses, it continues to run the business. So despite 5 billion losses, their operating cash flow is only 1 billion, and they were able to close that gap with borrowings. Okay, so that's cash flow statements is a financial form which is a required part of the financial statements, and it can be, so it must contain 3 types of cash flows: operating activities, investing activities, and financing activities. We will see if we can find the definitions in the financial statements guide. But apart from those 3 activities, there are 2 ways to prepare cash flow. One is indirect method and the other one is direct method. And there are 2 ways. These 2 ways exist only for operating activities. Financing activities and investing activities are the same. So these are the same between the 2 methods. The only difference is between operating activities and in operating activities. The direct methods, and it's called a preferred method under GAAP. Direct method wants you to record your cash inflows from customers, cash paid to suppliers, cash paid for salaries, for tax, for interest, and so on. They just want to show that direct cash. If you have just a few transactions, you can extract that information from your transactions, from your transaction list. But if your business gets more and more complex, you might not be able to do that directly. So you might not know how much cash did you get from customers because of the complexity of your relationship with customers. Or, for example, if your company is a consolidated company of many different subsidiaries with many different systems, and you only get like a basic information from them, only their balance sheets and income statements, and consolidate it into your system, then you will not have access to the information to prepare a direct method of cash flows. In the under the indirect method, you start with net income, and then you adjust that net income for non-cash items like depreciation. There is actually plenty of stuff there is a plenty of possible adjustments, and then you adjust it for the changes in assets and liabilities. Like for example, if you bought an inventory, and that's an example which we considered a bit earlier here in the practice. So you bought an inventory. You paid to suppliers $20,000. Here it is, that transaction. You bought inventory, debited inventory, credited cash. Your income didn't change. Your income remained the same. You didn't make any income on that transaction. Zero income. But you actually had a cash outflow. So under the direct method, it's cash paid to suppliers. It's obvious. But what's under indirect method? Indirect method, your net income is zero. No income from that transaction. It is a cash transaction. It is not a non-cash transaction like depreciation. But you had a change in your assets and liabilities. And because your assets increase, as you might see here, where it is, subtract increases in operating non-cash current assets, add increases in operating current liabilities. We will take a look at liabilities too, but let's deal with assets so far. So we had increase in assets, and that was increase in inventory. So we had cash outflow. So now we have total operating cash flow, indirect method 20,000 and direct method 20,000. Let's see where it is, minus 20,000. So under both methods you should have the same result. However, you will arrive to that result by different means, and we can use direct method as far as we have pretty detailed transactions list. If we go into some complex consolidation, then we no longer can do direct method. Okay, let's open our lecture document, and now I will go through guidance, and we will try to extract some useful information from the guidance. Okay, is it the right guidance? Just give me, yeah, I have something highlighted here. Should be the right one. Let me just scroll down a bit. Yesterday I ran through that guidance, and for some reason I don't see my marks here. That's strange. I probably just didn't save it. Just give me a second. I'll see if I can save it on my other computer. Okay, so let's go to the beginning. So our main task with a cash flow statement is to classify It is to classify the activities as operating, investing, and financing activities. Guide classification within the statement of cash flow. Proper presentation begins with understanding what qualifies as cash and cash equivalents. So we need to define cash and cash equivalents and what does not. From there, classifying cash flow as operating, investing, or financing can often be a challenge, especially for cash flows related to non-recurring transactions. For following section, explore these topics. Okay, so basically our main source of the guidance, authoritative guidance, is ASC 230 statement of cash flows. However, in some difficult circumstances, we might face the need to read additional guidance. So for example, if you are in an entertainment industry and you prepare a cash flow, you go to that guidance first, and then you see, okay, there is something about entertainment industry which I need to look at. Or if you are a non-profit, or if you are real estate. So sometimes your situation might have additional complications. Most of the time you go to that guidance and you can use it to prepare the cash flow. Okay, let's see. I was working in that document yesterday on another computer, and it looks like it doesn't save changes automatically. I just highlighted several interesting moments in the guidance. So what do I do usually? So in that case, when I prepare some memo for myself about the guidance, I start with that authoritative guidance. And then I go and try to collect some definitions from the standards, just to know what I am dealing with. Okay, my document is moving. So ASC requires a statement of cash flow as part of the full set of financial statements for all reporting entities. With some exceptions, of course, but we will not look into exceptions right now. We have a lot of other interesting stuff to do. So it's a primary financial statements, and is required for each period for which an income statement is presented. And usually for public companies, so that's a quarterly report. So for public companies listed in the United States, which are subject to SEC, State Securities and Exchange Commission requirements, it's 3 years. You can see IMC has 3 years, and if you take a look into SEC Financial Reporting Manual, you will find the requirement there that it should be 3 years. 3 years of cash flows. Okay. So let me refresh. Let's try this one. Now I will try to find definitions. Okay, looks. So there are some exceptions for investing companies, a common trust fund, a defined benefit contribution post-retirement plan. So these are the exceptions. We don't deal with them much. They are pretty rare. There is also some newer guidance coming up, and like for example, implementation costs incurred in a cloud computing arrangement that is a service contract. That might be the case in your situation. So that's when you are a buyer for cloud computing arrangements, and that's when you capitalize some implementation costs, and it provides some useful guidance. So you need to give that document a read once in a while just to see if anything was updated. There might be issues related to leases. Let me turn on the highlighters so we can have issues with leases. We can have here are the information about entertainment. So for example, cash outflows for the costs incurred to obtain the rights acquired under a license agreement for program material as operating activities. So some cash outflows for the rights under a license agreement. For example, you might face a decision where to treat these as an investing cash outflows. You kind of invest in some license or as operating, and that guidance can help you there. But that's for broadcasters and entertainment, so it's also not universal. What interesting do we have here? We have a cash basis method of reporting. Reporting activities in the statement of cash flows is predicated on the cash method of accounting. As you might remember from previous lectures, we have accrual basis of accounting and cash basis of accounting. And we are clearly guided here that reporting cash flows involves no estimates or allocations and few judgments except regarding classification in the cash flow statement. And we are talking about cash basis. It means that our operating, investing, and financing items should be on a cash basis, should be reported on a cash basis. If we use a direct method, it's obvious we will have that on cash basis. Basically, a direct method is when you go and pick up each cash movement. So you pick up each debit or credit cash under the direct method, and then you classify that cash under either operating, investing, or financing activities. In the indirect method, you basically do the same for investing activities and financing activities, but for operating activities, you kind of have to reconcile your accrual basis to cash basis, and the classification might require some judgment from you. FSB Concept Statement 5 is one of the sources for the guidance for cash flows. It is preceded accounting standard codification. So accounting standard codification is a more recent guidance for cash flows, but they still listed it in the guidance section. Let's see here. Okay, FSB Concept Statement number 5. Here it is. So let's go try to find some definitions. We have too much introductions here. Okay, broadcaster, cash basis of reporting. How should a reporting entity report the acquisition of long-lived assets if the financial statements, if it has not remitted payment at the end of the reporting period? So we have let's imagine a situation. That's an example for the cash basis. We acquired a property, but we haven't paid for it yet. So no cash change hands, no cash movements. We acquired a property, let's say it's a car, And but we say the vendor who sold us the car that, okay, we will pay you next year. It's December, end of December, we are tight on cash, and we say him, we will pay you next year. What is there any cash flow impact from that transaction? And the answer is no. Prior to remittance of payment, the acquisition of a long-lived assets is a non-cash investing activity. So it will not be reflected in the cash flow. However, there is a separate requirement to list your non-cash investing activities, and you usually list them under your cash flow. Let's see what IMC has here. So we have like supplemental disclosures of cash flow information, and we have cash paid during the period for interest and income taxes, and then we have a schedule of non-cash activities. Construction payables at period end. So that's basically your non-cash investing activities. And they have some other stuff specific to AMC. I don't even know what is DCAP, digital projectors transaction mean. But whatever, they probably got some projectors for their cinemas from someone on some seller financing arrangement, so they didn't pay cash for it. Okay, let's do guidance. Format. AC allows a reporting entity to prepare and present its statements of cash flow using either the direct or indirect method. So let's go to our lecture materials. Format. Direct or indirect. So we already know that. And we also know that it only relates to operating activities. Okay. What else do we have? Sample. We have just reviewed that sample in the previous lecture. This is an illustrative cash flow statement prepared using the indirect method. It reflects certain captions required, bolded, and other common captions. Not all captions are applicable to all reporting entities. In addition, some captions may be reflected in other classification categories depending on facts and circumstances. Not all items discussed within this chapter are presented in the figure. So that is not exhaustive. We have pretty high number of captions here, but we might have more. Like, for example, they do not have like owner contribution for cash flow from financing activities. And remember, indirect and indirect methods. Investing activities and financing will be the same, while operating activity will be different. Let's not drone into details right now. And at the end of cash flow, you will have net change during the period. So that's a total for all of three, for operating, investing, and financing. You might also have an exchange rate impacts. And exchange, if you have balances in different currencies or subsidiaries in different countries which operate in different currencies, you need to read statement of cash flow guidance very accurately in respect of foreign exchange gains and losses. That's foreign exchange gains and losses is a big pitfall in cash flow statements. Okay, direct versus indirect method. Might be presented, cash flows related to operating activities might be presented in one of two ways, the direct method or the indirect method. The presentation of investing and financing activities are identical under the direct and indirect method. Okay, let's see if I can copy it from here. No. Okay, what's going on? Yeah, okay, let's just remember that. Although the presentation of operating cash flow differs between the two methods, both methods results in the same amount of the net cash flows from operating activities. So our result should be the same for operations under both methods. And the standard encourages the use of direct method. The large majority of reporting entities elect to use the indirect method. So most of the companies, at least the public ones, they use the indirect method because you basically cannot, with the level of detail you have about your operations, and if it's a complex operations, you do not have enough data to use a direct method. That's the first argument. Then, even if you use a direct method, the standard requires you to reconcile your operating cash flow to net income. So basically that reconciliation of operating cash flow to your net income is what we are doing in the indirect method. So when we run our indirect method cash flow, so this one, so here is net cash used in operating activities, here is the net loss, and these all are reconciling items. So even if AMC prepared their income statement under the direct method and they get this 660 million cash outflow, they will have to repeat all these steps just to satisfy the requirement of the standard. They will have to reconcile their operating cash flows to their net income. And that's why so even if you decide to do a direct method cash flow, you will have to do an indirect method cash flow too, because that is a standard requirements. So these are the captions which are required in the direct method. So here it is. The direct method also requires a reconciliation of net income to net cash flows from operating activities. And that reconciliation is basically what we do when we do indirect method. We reconcile net income to cash flow from operating activities. And when we do direct method, standard requires us to reconcile cash flow from operating activities to indirect method. To net income, which is basically the same procedure. So with the direct method, you basically do your cash flow twice, and that's why no one is doing that. Okay, how good are we on time? 30 minutes. Okay. And here is the description of the reconciliation which we can perform. So we deferrals of past operating cash receipts and payments, which is our opening accounts receivable and payable, accruals of expected future operating cash receipts and payments, all items included in net income that do not affect operating cash receipts and payments, like depreciation, amortization, gains and losses, and so on. So here we have a list of adjustments for balances, and we have adjustment for non-cash items like depreciation, amortization, provisions, and we also have adjustments for cash flows from investing and financing activities recognized in net income. So some of our investing and financing activities can be part of our net income, and we need to reclass those activities from our operating cash flows and to our investing and financing activities. Reporting entities have latitude on how they present an indirect method reconciliation. Indirect method yields information that is less useful than the direct method. For example, because the individual line items within the reconciliation of the net income to net operating cash flows do not represent cash flows, they by themselves provide no incremental information about the reporting entity cash flows. So what they mean here, why they like a direct method more, is because in direct method we have cash received from customer. It's pretty clear and straightforward. While in the indirect method we have kind of net income and we have kind of some adjustment for receivables, and those two cash flows, those two numbers do not provide us as much information as cash received from customers. So that's why the standard likes direct method more. Here we have a good example. As I reminded you, foreign exchange differences can be a big pitfall for you. And if you deal with foreign exchange transactions or valuations in your work, and you have to prepare a statement of cash flows, you have to read that example very accurately. As you can see, they drill it down to each accounting entry. And for example, in that case, they have 1,200 accounts payable, which they actually settled for $1,150 because $50 was an exchange rate difference, and that basically has an impact on cash flow, because in your operating cash flow you should have that number which you actually paid, not the one which you have before the foreign exchange difference. What other? Okay, finally we have some definition. We have definition of cash, and to get that I copy it here. Yeah, for some reason that software okay. Finally. Okay. Cash includes cash on hand, demand deposit with financial institutions, money orders, certified checks, and cashier checks. Okay, finally we got to some meat here. There is a bigger definition of it, like additional, may deposit additional funds at any time and also effectively may withdraw. All kinds of accounts that have the general characteristic of demand deposits, and so on. If we have bank overdraft generally will be a financing activities. When our cash balance is negative, that's an overdraft, and that should go to financing activity, unless we have some agreement in place which pools our different bank account into one pool. You can find more information here. So when you deal with some multiple company entity, a consolidated entity, and it has bank accounts at the same bank, but you entered into agreement with that bank that it will treat all of these different accounts as a one account, and if you have a deficit in one company but profit in the other company and it nets up to zero, you can still treat that as a zero for your cash. But in other, if not, if you do not have such an arrangement, your bank overdrafts will be just like financing activity. Book overdrafts, it's when you wrote more checks than you have cash on hand. That's usually that's a non-cash activity. And we also have cash equivalents. And I will also copy it here. Okay. It's kind of too much information here for our lecture. Money market funds. So the guidance here dips into details what is cash and what is not cash. Auction rate, securities, cash, accounting policy defining cash equivalents, restricted cash. So there is no definition for restricted cash, but it is generally included into your cash equivalents and restricted cash. If you go take a look at AMC, here they say cash equivalents and restricted cash at the beginning of the period. Compensating balances. Balance sheet presentation, cash flow presentation. So basically your movement of restricted cash is just the same movement as the cash. Gross and net cash flows. That's important because overall you need to show cash flows on the gross basis, and there are only few exceptions available for the net presentation of cash flows. Like for example, if you have short-term borrowings for less than 3 months, certain short-term borrowings, certain hedges and items hedge, which you obtain and repay on a frequent basis, you can show those as on a net basis. But overall, you report them on the gross basis. Okay, finally we get here. We identify 3 classes of cash flows: operating, investing, and financing. A cash flow is first evaluated to determine if it meets either the definition of investing or financing cash flow. Let's take that part. So basically we first determine if we have investing or financing. If the cash movement meets the definition of the investing or financing, and then whatever is left we just assume this is an operating cash flow. If it doesn't meet a definition of investing or financing, we assume this is an operating activities. Investing activities. Investing activities include making and collecting loans, purchasing and selling debt or equity instruments or other reporting entities, and acquiring and disposing of property, plant and equipment and other productive assets. So basically, if we buy or sell property, plant and equipment, or something else with the purposes of investing and getting a return, that's most likely an investing activity. But we shouldn't confuse that with inventory. Cash flows from purchases and sales of property, plant and equipment, insurance proceeds directly attributable. So that's an interesting one. So if we got an accident and we got into trouble, I would probably just copy all of that to the document. because that's an important piece of guidance. So that's basically your main task, where you go and let's call it here investing. Let's see. No, I don't like it this way. So the standard has like a comprehensive list of what is an investing activities. For small businesses, for usual small businesses, when you buy a property, plant and equipment, it's an investing activity. When you sell property, plant and equipment, it's an investing activity. When you put your money on a certificate of deposit, that's an investing activity. If you speculate with securities, that might be an operating activity. Let's see if they have it here. Gross cash received or cash payments resulting from the acquisition or sale of debt securities or equity securities is usually included into the investing activities. However, interest income or dividend income receipt in cash on such investment securities is an operating cash flow. And trading securities, let me just highlight it by red here. Trading securities, when you trade to generate trading profits, should be classified as operating activities. So that's an interesting one too. So distributions from equity method investees. There is a lot of stuff which is not applicable for a usual business, but the guidance still listed because the guidance tried to be universal. Acquisitions of loans, proceeds from settlement of corporate-owned life insurance policies. Okay, financing activities. Financing activities include borrowing money and repaying or settling the obligation and obtaining equity from owners and providers owners with a return on or return of their investment. Okay, let's copy that. So transactions with creditors, repaying or settling the obligation, borrowing the money, obtaining equity from owners and providing owners with a return on the money. Payment for debt issue costs, payment for debt repayment, proceeds from leaseback transaction, failed. I don't really know what this failed sale leaseback transaction is. Proceeds received from issuing debt. Payments on seller finance debt related to the purchase of property, plant and equipment and other productive assets. The incurrence of that debt is a non-cash financing transactions. So there is an interesting situation with the seller's finance debt. Let's see where our homework is. So in that case, for example, that transaction, they could have been treated differently depending on who finances the transaction. If we got a financing from a third-party bank, then we would reflect cash outflow for capital 200K and cash inflow for mortgage 150K. But if we did a transaction with a seller, if seller financed the transaction, or we got that item under financial lease, which is basically a seller finance too, then we would only reflect 50K as an investing cash outflow, and we would only reflect we would only reflect 150K as a non-cash investing activity right here under the statement of cash flow, like a construction payables at the period end. So that's a big cash flow pitfall too. Okay, we approaching the end pretty fast. And so cash dividends and purchases of treasury stock, it's all financing activities. Stock issuance proceeds. Remember, we recorded one transaction in our homework. Here it is. Investing. Financing. Owner contribution. Issue of shares. Okay. Cash dividends. Okay. Operating activities. Cash flows that are not investing or financing are operating activities. Receipts and payments that enter into the determination of net income. Receipts from customer, interest and dividend receipts related to investments, payments to vendors. So customers, vendors, payments to creditors for interest. So interest paid, interest receipt is operating activities. Dividends receipt is operating activities, but dividends paid is an investing activity. Okay, I wasn't able to find it. So sorry, dividends paid is a financing activity. And let me see. Stock issuance, seller finance, cash dividends and purchases. Stock buybacks is a financing activity. Let's see. Apple SEC. So Apple, I believe, pays dividends, and Apple also repurchases its stock. So we want to look at annual report, PDF, and we want to look into financial statements here. Let's go to Apple cash flow. Consolidated statements of cash flow. Apple. Financing activities. Proceeds from issuance of common stock. Payments for dividends and dividends equivalents, $14 billion. Repurchases of common stock, $85 billion. So Apple spends a huge deal of money on repurchases of common stock, $85 billion. But they can afford that. Their operating cash flow is $104 billion. It's huge. Though they have net income of almost $100 million. So that's a fresh Apple income statement. So they have 55 billion profit, 57 in 2020, and now they have 95 billion. That's just huge. I mean, with that net profit, one can substantiate 2 trillion valuation for Apple. Okay, let's go back to our guidance. We have 5 minutes left, so we have operating activities here. There are a list of items which we can, which sit in net income, but which we might want to reclass to other. For example, like debt extinguishment cost might be an financing activity, or foreign currency might be part of different activities. Gains and losses on the disposal of property, so that's an investing activities. Non-cash investing and financing activities. ASC 230 requires a separate disclosure of all investing or financing activities that do not result in cash flows. And if you remember, here for AMC, we got this here, non-cash activities. And do we have anything like that for Apple? Supplemental cash flow disclosure. Cash paid for income taxes, cash paid for interest. Yeah, $25 billion in income taxes. That's huge. So if you have non-cash investing, when you acquire something under the financial lease, then you have to disclose it separately. So basically, when you have to prepare cash flow, you need to go read the guidance first. And when you read the guidance, you just highlight the items which you have in your company. And then you read the guidance on these items and you just make sure that you are not missing anything. So every time you think you need to work on your cash flow, go recheck the guidance, make sure that you have some understanding of what transactions you have in your company, and then only then start to prepare your guidance. So if we buy an equipment but we do not pay for it, this is a non-cash transaction. Okay, so if we got into installment note payable to the seller, that's important. We also, if we paid 100 cash and got 400 installment note, we will consider that transaction in our practice. So let's see, installment note. And we might run into situations when we have a cash outflow, but the substance of that cash outflow is mixed. It can be a bit of operating cash flow and a bit of investing cash flow. And there the guidance is a standard which will help us to determine which one shall we use for that case. Okay, we are running out of time. I shared the link to the guidance with you. Hopefully you will be willing to read it through. Page 88. On the next lecture, we will go into our homework file and we'll work through our cash flows. Okay, so thanks everyone who is watching me, and I'll see you on the next lecture. Let me share the final link. That will be the final lecture for today. Final lecture for today. Yeah, I need some extra time to prepare for the next lecture. So thanks everyone for coming. Bye bye.